Have you ever had $100 in your pocket and thought, all right, how do I turn this into $1,000, $10,000, or maybe even $100,000 one day? I'm not sure if it's in the school curriculum now, but it definitely wasn't when I started. A lot of Canadians are scared to even start investing because nobody explains it properly. In this video, I'm going to walk you through exactly how you can start with just $100 step by step, and we're going to go from super safe to pure gambling. Investing can help you build real wealth over time, and you don't even have to start with $1 million inheritance like everyone I meet in Toronto. I started with a few $100, made a ton of mistakes, and slowly scaled up, so hopefully you don't have to make the same mistakes I did. Is getting rich easy? No, but if you take smart, calculated risks, you can grow your money over time. Everyone has a different risk tolerance, so here's how the video is going to work. I'm going to show you different ways to invest $100. We're going to go from low risk to high risk. And of course, if you get value from this video, please like and subscribe. I'm not selling anything to you in this video. All right, let's start with the safest place, which to me is a 0 risk out of 10. I would invest in myself. Spend that $100 on books, knowledge, or even finance courses from someone you trust, something that has good reviews. But assuming you've already done that, that's not what this video is for. We're going to risk 1 out of 10, which is a high interest savings account. The first place I'd look with $100 is not the stock market, it's a high interest savings account. Now, this is not going to turn your $100 into $100,000. In fact, in 20 years, $100 might even only turn into $125. And even then, you have to pay taxes on that extra $25 that you made. The point here isn't returns, it's safety, it's building an emergency fund. An emergency fund is money you keep liquid, meaning close to cash, in case something goes wrong. You need car repairs. Recently, I had a $13,000 car repair bill. Or you lose some hours at work, or a global pandemic shuts down the economy, or you broke a tooth the morning of your friend's wedding that you were supposed to MC. If you don't have cash, you end up putting emergencies on a card at 22% interest, and that's how the debt snowball starts. So with a high interest savings account, here's what I'd look for. A good interest rate. Obviously, check the different banks that you're looking at. Online banks pay more than the physical branch locations. You want something with no fees because you don't want to be charged to access your own money, and you want easy access to the money so you can pull out when you need it. SoFi has a standard in the US 3.6% rate, but you get 4.3% for the first 6 months. It doesn't have ATM machines, but it has a debit card so that you can pay with it. Think of this as your level 0 investing move. Before we try to grow our money, we want to make sure that one emergency doesn't blow up your entire financial life. I'd park that first $100 in a high interest savings account while you build up at least a small emergency fund. Let's say $500 or even $1,000 on the side is a game changer. Now we're going to talk about gold, a 2 out of 10 risk, the classic store of value. Paper money loses value over time because of inflation. Since the creation of the Federal Reserve in 1913, the US dollar has lost 97% of its value. Now, gold isn't about making you rich quickly, but it's about protecting your purchasing power over decades. It actually used to be the basis of everyone's currency, like how much gold can $1 buy. Gold tends to hold its value over the long term. It actually seems to be beating the stock market, or at least in the last few years. If you're watching this in 2025, it's had a 50% increase over the last year and over 100% in the last 5 years. But this means people are preparing for a recession or a bubble. If you're watching this at the end of 2025, we may or may not be in an AI tech bubble. So come back to it when that happens. But there is a catch. The reason why this is a 2 out of 10 on the risk scale, if you put your $100 into gold, that money might grow slower than other investments, and that's the opportunity cost. During prosperous times, stocks or other investments perform better than gold. You have 2 main ways to invest in gold. Physical gold, like the coin, bars, or jewelry, it's cool to hold, but you usually pay a markup above the gold value because someone wants to make a profit on that jewelry they're selling you. Or you could do gold ETFs in a brokerage account. These trade like stocks and they track the price of gold. You can actually buy and sell quickly with low fees. I would purchase GLD. It's the largest gold ETF and it trades just like gold. For most people, if they want gold exposure, an ETF is easier and cheaper than buying physical gold bars. It's not something I'd focus on with my first $100, but it's a tool in the toolbox once your portfolio grows. My personal preference, I like holding the physical gold, maybe even touching it to your face every now and then. Number 3, index funds and ETFs, a 3 out of 10 on the risk scale. Now we're getting into the good stuff, which is the ETFs. This is my specialty. I recently made a video on the top 4 ETFs to invest in. If you're actually looking for proven examples, and if you're thinking, hey, I don't want to think about this every day, I just want a simple long-term way to invest, this is it. An index fund or ETF lets you buy a basket of companies all at once. Instead of picking one stock at a time and praying that it does well, you own a small piece of hundreds or thousands of companies. We've got a few good examples, like if you want to invest in the Canadian market, like the TSX, you'll invest in XIC. If you want to track the US market, you can do VFV or XUS, and you can even do global ETFs that hold companies around the world like XEQT or VEQT. Those are the same thing to me. Here's a super simple example. If you invested $100 in a month in a broad ETF like the ones I just mentioned, let's say, I think the S&P 500 averaged 9% per year. And if you invest over 25 years, so you invest $100 a month, you'd end up with over $100,000. And that's the power of compound growth. Canada and the US have similar accounts that let you protect your investments from tax. You could use the Roth IRA or the 401k if you're in the US. You could use the TFSA or RSP in Canada to protect your returns from getting taxed. The tax-free savings account, you can invest after-tax money, and the gains and withdrawals are tax-free. If I'm a beginner in Canada and I have $100 and I've already started my emergency fund, this is probably where I'd look to next. I would open a TFSA, buy a low-cost broad market ETF like the ones I just mentioned, and I'd leave it alone. Next up is REITs, real estate investment trust. The risk is a 4 out of 10, depending on how much you know or where you invest. Like Canada, for me, it's a 5 out of 10, but the US, I feel like they're a little safer. Real estate is a huge wealth builder, but not everyone can drop hundreds of thousands of dollars on a shoebox condo in Toronto or New York. This is where real estate investment trusts come in. This is my specialty. I may or may not have been consulting for the top 8 REITs in Canada over the last 13 years. A REIT is basically a company that owns income-producing properties. So you can have apartment buildings, shopping centers, industrial warehouses, or office buildings, or a mix of like retail and apartment. You can buy a share of a REIT or a REIT ETF. So that means like a basket of 10 or 15 REITs for as little as $50 or less. And you're effectively owning a tiny slice of a big real estate portfolio. And the best part, the reason why I think a lot of people like these, by law, REITs have to pay out a large portion of the profits to investors as distributions. Distributions are similar to dividends, but they're taxed differently. So it's a way to get exposure to the real estate and the cash flow without being a landlord or dealing with tenants. In the US, they have to pay 90% of the profit out as distribution, but in Canada, it's 100%, which is why in Canada, it's a little bit more riskier because they have less cash to reinvest for themselves. With $100, you're not buying a building, but you're starting to build a stake in the real estate world. Number 5, flipping stuff, a risk 5 out of 10, buying and selling random items. This is something more entrepreneurial, buying and selling random items. This is less investing and more focused on building a micro business. I did this kind of by accident with GPUs. I started buying NVIDIA GPUs for my mining business, but I ended up with too many and I actually didn't have enough electricity to power them. So I started flipping them. Let's say I bought for $700, sold for $1,700. So I actually started making more money in flipping the GPUs than I did mining up until 2025, but I'll talk about that near the end of the video. Let's say you take $100, you buy underpriced items and you resell them at a profit. The key here is knowledge. Like, what do you know? What's your niche? Maybe you know hockey cards, maybe you know sneakers or furniture, maybe you know like camera gear, gaming, or like Pokemon cards, but they're probably more expensive. The more you understand a niche, the better you are at spotting deals. In Canada, a good place to start, let's say Facebook Marketplace, Kijiji, or even like garage sales. Buy a used item for $60, clean it up and sell it for $120, and suddenly your $100 is $160. If you do that repeatedly, the return can be massive compared to just parking the money into an account. If you want to be a little devious, One of my friends wouldn't even clean up the products. He'd buy it and resell it right away, and people would buy it. The downside is that it takes time and effort. Sometimes you misjudge demand and you get stuck with something that doesn't sell. Next up is individual stocks, a 6 out of 10 risk. It could be higher or lower depending on your knowledge base. Instead of owning a whole basket of companies through an ETF, you're now putting your money into one stock at a time, one company at a time, like Apple, like Google, like Microsoft. The upside is if you pick a winner, your returns can be huge, like Nvidia. The downside, if that company flops, your $100 can go to zero. Seriously, you should slap whoever told you to invest in this company. Also, the CEO should go to jail, but apparently white-collar crimes are illegal now. Serious stock investors usually do fundamental analysis, but when I try to teach that on this channel, people aren't interested because it's too complicated, so they just want the final answer, but it's fine. Most people, when they do fundamental analysis, they look at revenue and profit, debt levels, competitive advantage, or even like management and the long-term growth potential. But here's the truth. Even with all that, there's still luck and timing involved. If you're brand new, I wouldn't start here with your $100. I'd personally treat individual stocks as something that you do after you've built a solid base, like emergency fund, you got a little bit of gold, you have your ETF, and then I would go into the individual stocks. All right, number 7 on the list, cryptocurrency, a risk 8 out of 10. But if done correctly, in my opinion, it's a lot safer, but only stick with the 2 main coins. This is my recommendation, my opinion only. And I've been lucky and I've done well with these over the last 10 years. I would only look at Bitcoin and Ethereum. The returns can be insane, but the directions, in both directions, it can be extremely high, extremely satisfying, or very scary. We've seen periods where $100 in Bitcoin a few years ago could be thousands or hundreds of thousands, but buying at the peak, let's say if you bought in 2017, the $100 could turn into $20. That's only if you sold, but all you have to do is hold. You only crystallize the loss if you sell. But I'm a believer in the long term. Just keep in mind, crypto is volatile and highly speculative. It's not currently based on anything, and I actually don't think it'll ever be a currency. Some people treat it like a lottery ticket. Some people like genuinely believe in this technology and use it as a small part of their diversified portfolio. If you're going this direction, I would only put 10% of my investments into cryptocurrency. And here's my view. If you're going to touch crypto at all, it has to be with money that you're 100% okay losing. It's not something that you want to build your entire financial life on. Like I mentioned, I'm a pretty big investor or believer. So I was mining Ethereum for a few years and even managed to swing trade a fairly large position. So I had around 488,000. This was in September 2025, and my cost basis was around $17,000. So over 8 years, I've gotten very lucky. But this was in September. Right now, I'm filming this near the end of November, and it has dropped significantly. But I had cashed out at that point. Maybe that's a topic for another video. Number 8, and maybe last on the list, is the lottery, a full 10 out of 10 risk, full gambling. I'm including this one not as a recommendation, but as contrast. From an investing perspective, the lottery is basically the worst expected return you could possibly choose, but the potential rewards are huge. I never actually realized until doing the research for this video, over half of North American population play the lottery. I think it's like 53% of North America plays the lottery. But here's the thing, the chances are you'll never even meet someone who has met someone that has won any kind of large jackpot lottery. The odds of winning are tiny. Like millions of people lose money every year while hoping to hit it big. Even I do. So I play the Princess Margaret lottery. It's more expensive and I win headphones every year. So it's not a complete loss. If you take that same $100 that you were going to buy a lottery ticket with, open up a high interest savings account for your emergency fund, open up a TFSA to invest in a REIT or an ETF, you'd be dramatically better off, and the chances of being better off are dramatically higher as well. I'm not here to tell you how to live your life. If you buy the occasional ticket for fun, that's your call, but building a financial strategy around it, around winning the lottery in Canada or the US, that's as bad as it gets. At least in Canada, a lottery winning or casino winnings are tax-free, whereas in the US, I believe it's taxed as a windfall, which is over 50%. So what do you actually do with your first $100? That was a long-winded way to give you some advice if you actually made it this far. If I were starting with $100, here's how I would do it. If you have no savings, start with a high interest savings account and build a small emergency fund. If you have the emergency fund already, open up your Roth IRA or your tax-free savings account, pick a low-cost broad market ETF like the ones I mentioned earlier in this video, and start investing there. If you're already investing consistently, try to add a few REITs or maybe some individual stocks after you've done your research. And then lastly, crypto, only with money that you're truly investing, only with money that you're truly okay losing. It's not really investing, it's more speculation. If you think about it from your casino money bucket and not your future house down payment bucket, the goal is not to get rich overnight. The goal is to build wealth over the long term. Thanks for watching and tune into the next one.